Okay, so ladies, let's start. Good afternoon, everyone. I can see your chats. Good afternoon. How are you today? It's been a few days since we spoke last. I trust you're all doing good and that you're all keeping safe and well, even in this period. So as it is our usual practice, today is Thursday, and it's time for our 5th masterclass for the Aspired Entrepreneurs Program. And we have none other than the only coach, outside of myself, who is also a masterclass facilitator. I'm sure her participants will be excited, to have their coach also facilitating the session. So let's just talk about Ife. Ife Ibitokun, she's a LearnTech entrepreneur. She is a chartered accountant and she has extensive years of experience. She's the founder and CEO of BizNurture Financial Services Limited. Her organization, BizNurture Financial Services Limited, has received awards as one of the fastest 100 growing SMEs in Nigeria by Business Day in 2018 and 2019. She's also been an associate member of WinBiz. She's an associate member of, and she's also a member of God's Own Diva Club. She's won several awards and recognition for her work that she does, especially with financial inclusiveness for women. So ladies, today we have Ife Ibitokun, who will be taking us on everything that we need to know on how to finance our business. Ife Ibitokun, thank you so much for honoring this invite. Thank you for the work you're doing with your participants. We've got some fantastic feedback from them. Thank you. And yes, the floor is yours.
Okay, thank you very much, Sheyi, and good afternoon, everyone. It's nice to be here. I just want a bit of feedback. Can you guys hear me? Sheyi, I think I'll get more feedback from you, given that you are live. So if you can hear me, just raise up your hands virtually or say I can hear you.
They can.
Okay, fantastic. So I will be sharing my screen to take you on financing your business. I'm excited about this. I'm always excited to teach accounting actually and finance, right? Because I think out there, so many people, when we go for courses like finance and accounting, it's like, okay, what are these people saying? But then I try to break it down. And given that I can't see you guys, I would have loved to see you guys, just to get that feedback, but I can't see you. But I expect that there'll be a Q&A after. So yes, if there comes to any point where I say any financial jargon, please put it in your Q&A and let me know. I will break it down. Okay, I'm going to try, my presentation is going to be something that is quite relatable to you and where you are right now. Okay, so give me a moment, I'll be sharing my screen. And please let me know when you can see it.
Okay, I will. Yes, we can see it now. Okay, fantastic.
All right, so let's get right into it. Financing for your business. Finance is very wide, or numbers, anything that has to deal with numbers in your business is really wide. So I know last week you guys did a bit on, you did a class on pricing, you did revenue, profitability, and all of that. So I'm going to be taking you another aspect, and my presentation outline will be as follows. We'll define financial statements, and then I will walk you through the key financial statements you need as a business owner using a case study. So we are going to be telling, I think, 2 stories, right, on this. So that's what I'll do. And then we'll now move to funding for your business, talk about the types of funding, all down to where you can get funds. And then I have a pattern advice for you. And then I'll take questions, right? So Right to it. What are financial statements? When you hear financial statements, what do you think? And I know what you think, right? But my simple definition here today is that it is a system of recording information about your business in a numerical form. That's simple, that's straightforward. Forget if you want a complex definition, please go online, you will find a lot of them. Today, I'm here to be as simple as can be, right? So financial statements are just statements that show the numerical information about your business. That's simple. Now, let's go straight to the case study. I'll talk about why you need them at the end of my presentation. So let's go to the case study. So this young lady right here, I mean, we're all women, so yeah, ably represented. This young lady right here, her name is Mayowa. She's an entrepreneur, just like you guys. She started out at some point. She's 31 years old. She lives in a comfortable apartment. If hardworking entrepreneur, I'm sure we're all hardworking, right? And she's a fashion designer. She has a client base of 50 customers and a current bank balance, right, as we speak right now, is 3.5 million. Okay. So, I mean, Mayowa, again, like I said, she's a hard worker. She looks at her bank balance and she's like, wow, woo, I've done very well for myself. This is money that I can enjoy. What can I do? I mean, I've not taken a break in the past, 2 years since I started the business. What can I do? And what did our dear Mayowa do? No calls, no emails, no kidding. She decided to go on a vacation just based on the fact that she had 3.5 million in her account. And she's like, look, I can ball, right? So she traveled to an exotic place, maybe the Bahamas, I don't know, right? And she spent a whooping 2.5 million. I mean, she had 3.5 million naira in her account, right? And she's worked hard. So she's allowed to spend a little on herself and enjoy, right? So she did that literally and went ahead to enjoy herself. Now, there's always that journey after the vacation, right? You come back to the business, okay? Look at her, hair scattered, worried, and what happened? What did she not know, right? What went wrong? So Mayowa, like most entrepreneurs, did not keep a proper record of her expenses and revenue, right? I mean, she just saw money in her account and she's like, oh, people are paying me, she wasn't tracking anything. Even the expenses she was yet to pay, she was not tracking them. She just had an idea that she was owing people, right? And the mistake she made was assuming that her bank balance was her profit. And your bank account balance is not your profit. Let's first of all start from there. So if you have money in your account right now, or even if you don't have money, you might even be profitable if you don't have money, right? Or you have money and you're not even, it's not your profit, right? So she discovered that she had unpaid rents. And I'm going to be using the Nigerian currency. I understand that we have people joining us from different countries in Africa, but I'll be using the Naira for the purpose of this presentation, okay? So she had unpaid rent of 800K. Electricity bill was outstanding, 50K. She had tax to pay, 200K. Staff salaries, she was here to pay. But then all those things did not occur to her just because she wasn't keeping proper track records, right? Proper records, right? She just assumed that this is profit. And then she was in the dilemma. So in accounting, there are 4 pillars, and that's why it's good. I'm not trying to make you an accountant on this call, right? What I'm trying to make you is understand business finance as an entrepreneur. You can get your accountants to come and help you out with your books, but then you don't want them to be speaking jargons to you and then you're like, what is this person saying? I can't just wrap my head around it. It's always good to know your numbers. I should be able to call you today. The same way you can talk to me about your business, you should be able to talk to me about your numbers, right? So in accounting, there are 4 pillars, right? And those 4 pillars are assets, liabilities, expenses, and income. So I'm going to deal with each of them, okay? So what are assets? Assets are simply items you have paid for that will give you benefits for over a year. That's the simple definition. Again, if you want more complex definitions, please go online, right? And go and Google, you would find them, okay? So an asset is something that simply gives you, you can use beyond a year, right? So if you think about a car, if you buy a car, right? How long can you use it for? You don't use it for a year and then you dump it. It gives you benefits for over a year. So that is an asset. If you think of your computer, a computer is not something you use now and then you dump it, right? You use it for over a period of time, right? That is an asset. Now, I put 2 questions. What is your pen? Is it an asset? You can put the answer in the chat box. So is your pen an asset, given the definition of assets that you know? Do you think your pen is an asset? Okay, what about your fuel? The fuel you use to run your gen or your car, is it an asset? So if you buy fuel today, can you use it for the next 1 year? All right, so your guess is as good as mine. Okay, I can see the answers coming in. So a pen is not an asset. I mean, in fact, pens, sometimes you buy a pack and by the end of the week, the pens have walked away, right? So that is not an asset, right? Fuel, we consume fuel once you fill your tank, 2 weeks, that's the end. So that is not an asset. So an asset is something that will give you value for over 1 year. Assets are also people who owe you, that is your debtors. So you give off money to someone or you sell your goods on credit, right? Those people, the funds that are outside there, they are your debtors, right? That is also an asset to you because you own it, okay? Then there's also things you have paid for in advance, right? And you've not enjoyed the benefits. So a typical example is when we pay for rent. Usually when we pay for rent in Nigeria, it's for 1 year, right? But guess what? As of January, when you paid for your rent, you still enjoy the rent for, sometimes they even ask you for 2 years rent, right? So if they ask you for 2 years rent, let me use that example, just not to complicate things. If you pay 2 years of rent, it's an asset because the next year, you're just going to expend your rent month on month in 2020. The one you pay for 2021 is an asset to you because you are yet to enjoy the benefits. Simple, okay? Recall, if I start with financial jargons, please put it in the chat box. Now, what are expenses? Expenses are items you bought that are not assets. That's simple. That is, they don't last for more than 1 year. So you bought a pen, that's an expense. You bought your fuel, that's an expense. The rent you're paying for 2020, when you're drawing up your financials for 2020, that's an expense, right? Now, is car an expense? Yes, no, comments? I don't know how to see the chat. Okay, fantastic. I can see it now. So your car is not an expense. Your computer is not an expense, right? It is an asset because you enjoy the value for over a year, and an expense, e.g. a pen, is what someone said, it depends on the kind of car. Anyway, so an expense is something that you buy and you do not use for more than a year, right? Now let's move on. Okay, 1 minute, please. Okay, now let's talk about the other 2 pillars. Let's talk about income. Just give me a moment, trying to juggle. Okay, so let's talk about income, right? What is your income? Your income is money that you received that you do not need to return. So people have come to pay you for your goods and services, right? Let me minimize this. Okay, people have come to pay you for your goods and services. They've given, it is your money, right? You do not need to return it. So that is what an income is, okay? Now, I've given examples there. The 1.2 million for services render or for products purchase, that is your income. If you also have money somewhere in an investment or in a bank that the bank paid you interest on, that is also an income to you. I'm sure we all know what an income is because, you know, we like money. Now, liabilities. What are liabilities? Liabilities are money you get and you need to return. So it's like the opposite of income. Liabilities are funds you get and you need to return at a future point in time. Okay, so if a friend lends you 2 million naira, guys, it is not your money. It is your friend's money. It is a loan and you need to return it, right? I know some people who take funds and they take their friends for granted and they never return the money. It is not your money if a friend lends you money, okay? If you took a loan from a bank or a finance institution and you have to return it, it is a liability. It is not yours, right? If a customer, okay, before I mention the other one, another definition of liability are purchases you make on credit from your suppliers, or you've enjoyed a service and you're yet to pay for it. It is a liability because you owe them that money, okay? So someone has done something for you and you people agreed that you should pay on a later date, right? That is a liability. It is not your money. So an example, a customer pays you 1.2 million for services rendered or products purchased. Is that a liability? Let me see. Is that a liability? Responses, please. No, it's not a liability. Nah. If you receive 5,000 as your bank interest, is that a liability? No, it's not. So fantastic. We are grasping the concept. It's that easy. So all these assets, liabilities, when you hear people talking, financial statements, assets, liabilities, income, expenses, if you get confused, this is just the simple meaning of all of those things. So let's move on. Now, in accounting, there's an equation, right? What is the accounting equation? Your assets, we know the definition already, is equal to your equity plus your liability, right? We know the definition of liability already, okay? What then is equity? Now, these are the different, this walks us through what equity is. Equity is the owner's portion of the business assets, okay? So the money you bring into the business, you want to start up a business and you require 1 million to start up the business. That money, if you decide to fund it yourself and you're bringing that money into the business, that is equity, okay? Recall that asset is equal to equity plus liability. Therefore, we all did maths in school, right? 4 is equal to 3 plus 1. Therefore, 3 is equal to 4 minus 1. So equity, using the same equation, equity is equal to assets minus liabilities, okay? So when you're, like I said, when you're starting your business, you invest money and other assets, right? And the business in turn makes you a profit or a loss. So how do you know if you're making profit? Recall that profit is not cash, okay? Profit is the positive amount left after you pick your income and you deduct your expenses, okay? So if you make that positive figure, if it's a plus, right? If your profit is 5, if your income is 1 million and your expense is 300,000 and you make a profit of 700,000, who is the owner of that profit? Answers, please. Who is the owner of that profit? Is it mine? Is it for your sister? Is it for your family member? Who is the owner of the profit when you make one, the positive figure? So it belongs to you. It belongs to the business, okay? So therefore, profit is also part of your equity. So if you bring in 1 million into the business as your equity, and we're going to see a sample balance sheet, and you make a profit in the first year of 700,000, that's the money you brought into the business plus your profit becomes your equity. So a positive profit increases your equity. If you make a loss, what happens to the money you brought into the business? Guys, I need feedback. I don't want to be the one talking. Finance can be, we need that interaction. So if you make a loss, what happens? What happens? Does it increase your equity or it reduces your equity? Let me see the charts. Oh, fantastic. We have accountants in the house. It reduces your equity. Fantastic. So we're getting it, right? So let's move on. So let's come back to our darling, hardworking Mayowa that, went to ball. When she was starting a business, right, she had the idea to start up a manufacturing firm, right? And what does manufacturing firm do? They sew for big corporates, right? They sew for big corporate schools, organizations that want shirts and all of those things. So she decided, she had that business idea. And by the time she wrote out her business plan, she realized that she needed 30 million to start up that company. Luckily for her, she had saved about 24.5 million, right, for over a period of time. I mean, she had always known that she wanted to go into the business. So while she was on a 9 to 5, she was saving towards that dream, right? So luckily, she had 24.5 million. Now, don't forget that when she wrote her business plan, she realized that she needs 30 million. So there's a shortfall of 5.5 million, okay? So she approached the bank with her business proposal. Unfortunately, she got a loan, startup loan, maybe Bank of Industry, they're quite interested in this kind of industry, the manufacturing industry. So yeah, they gave her a loan. They were okay with her business plan, her projections and all of that. So she got the loan. So now, what did she do with the 30 million? So the total money she had to start her business now was 30 million. How much was her equity from what I just shared now? How much was her equity? Response, I don't want anybody sleeping on finance. So I'm going to ask you guys questions and you guys are going to respond. How much was her equity? Fantastic. Then how much was the debt she used in financing the business? Fantastic, 5.5 million. But the total capital she used in starting the business was 30 million. So it means that 30 million was financed by two types of finance, equity and debt, right? Now, let's go back to my presentation. So that 30 million was used to buy a property. I mean, to buy a property, she bought a property, she bought a van, and she had some cash left in the bank for running expenses. So let's see what her balance sheet looked like when she started. So this is it. So to your left, yeah, that's to the left of my screen, you'll see what her assets look like. So the property, 20 million, right? The car she bought was 4 million, and then she had 6 million naira left in the bank for running the day-to-day expenses, okay? Now, how was this funded? We had talked about liability and owner's equity. So she took a bank loan of 5.4 million, right? And her own money of 24.5 million. Recall the accounting equation. Your asset is equal to your equity plus liability. Okay, so when you start a business, right, you're bringing in money, that's equity. Sometimes you don't need debt, which is liability, right? But in her own case, she brought in debt. So sometimes some people's liability is zero when they just start out, okay? Now this money was used to fund her assets. Okay, I hope that's clear. I hope I've not lost anybody. And all these items you find on a balance sheet. So what then is a balance sheet? A balance sheet is simply that document that shows you a snapshot of your business as at a particular time. So all those stories I told you in the previous slide, just the slide before this one, oh, she started a business, she did this, she did that, she did that. If you present me with this balance sheet and you're telling me that, oh, this person just started a business, I can tell you what she did with the money she had. Okay, so and that's what a balance sheet does for you. It shows you the position of your business, the snapshot of your business at a particular time. Okay, now let's move on. So let's keep talking about Mayowa. Recall that she's in the apparel business. Okay, she manufactures apparels. So during the course of the year, Mayowa makes campaign t-shirts for a telecom company. And she charged them 15 million for that. That telco company made an upfront payment. So they paid her in advance, 4 million. And then the balance was to be paid 30 minutes after the job had been invoiced. So she's delivered on the job and she's submitted her invoice, okay? So that's that. I'm going to ask you a question after this before I show you the answer. Now, also, she got an order to supply 100 school uniforms for 1.5 million, okay? They paid her 70% immediately, and the balance, they will pay her 6 months after, later. And at this time, she would have delivered on the job, so they'll pay her 6 months later. Then she got several jobs here and there from individual clients, and those people paid her 1 million naira, and they paid her 100% cash. So there was no credit, payment, okay? There was no credit for individual clients. Now, some of the expenses she incurred: salaries of 1.44 million, office rent 800,000, raw material, she bought raw materials, she had to buy materials, right, to make those apparels. She bought them for 5 million. Bank, she was paying her bank interest on her loan, 825,000. And she had other overhead and expenses of 3.6 million. Now, there's another note there saying Mayowa still owes office rent. So that means she hasn't paid that 800,000 at all. And she owes part of the money for the raw materials. She owes 2 million. Using the 4 pillars of accounting we just talked about, can you itemize? I'm opening my chat box again. Let me know which pillar of accounting each of these fall under. All right, I'm waiting for a response. I'm not moving on without a response. So this is what has happened with Mayowa in the year, right? Using my explanation on the 4 pillars of accounting. Can you tell me where these things fall, under what pillars they fall? What is under the asset? What is under income? What is under liability? What is under expense? All right, answers. Olo says she's lost. Where are you lost? Yeah. So the 15 million is an income, correct, Diola? Okay, I'm waiting for a response. Raw material is an expense. Okay, Jovita, thanks. Oh, you didn't get the question, Nada. Okay, the question is, I've itemized some of the transactions that happened in her business in the year. So I'm asking you that under what pillars? I've told you 4 pillars of accounting, and I said they are asset, liabilities, income, and expenses. So under what pillar do these transactions fall? Bank interest liability, is it? Bank loan liability. Office is an expense, salary is an expense. Okay, Ulo, so that means you're no more lost, right? Fantastic. So thank you guys for your responses. So let me show you the answer. Now, using the 4 pillars of accounting, this is it. So what are the assets there? Don't forget that the cash she got is an asset. Cash is an asset. You find it in your balance sheet, cash, right? So the 4 million naira cash, the upfront payment, they paid her upfront, is an asset, right? Now, after she delivered on the job, they are still owing her for 30 days. That is also an asset because it's her money. She has delivered on the job and they are yet to pay her. So they are a debtor, but it is under the assets in a balance sheet, right? Now, the 70% paid by the school is also an asset, okay? And the balance owed by the school is also an asset. It's just that in your asset pillar, right, you separate them as cash and debtors, okay? So these are the people that have paid me cash. I already have that one in my bank account. These are the people that owe me, right? So that is also an asset, okay? Our other income was also received in cash. Okay, I don't want to really go into the concept of double entry because you begin to get confused. Again, I'm not trying to make you an accountant or a bookkeeper. This is simple. These are simple things you can write in your book when you're trying to, add up things. Her other income, don't forget that they paid her in cash. Okay. So cash is an asset, right? Now let's go to the income. You will notice that, she rendered a service, right? All her services rendered and the payments she expects are her income. So the 15 million from the telco company is an income to her. It's just that in the balance sheet, the entry becomes 2, okay? The telco paid her 15 million in cash, part of it in cash, and the other is a debtor. So both of them, you find them also in the assets. The school job, likewise, they paid her 70% in cash, and the balance of 30%, they are owing her. So they are a debtor. Monies for services rendered that have not been paid, right? So, and in your businesses, you can relate with this because some of you sell on credit. Okay, so if you sell that hair wig on credit and people don't pay you upfront for it, you're like, okay, pay 50% upfront, and then the balance of 50% can come in after you've received the wig. At that point, it is an income to you because you've made that sale, but then in your balance sheet, you only have cash of 50% and the balance you have as debt of 50%. So you know who to chase. Don't record everything in your balance sheet as if it is cash, because that way you will not be able to chase your debtors. Okay, I hope you guys are getting it. Again, I'll take questions at the end. So I would advise that you write down your question. Maybe you want to write that then. I don't know if there's a Q&A chat box separate.
Yeah, they can put the questions in the Q&A box. They can start sending it.
Okay. Okay, so put them there. Don't put them in the general chat box because it might be lost, okay? Now, expenses, salaries, office rent, all of those things are expenses, raw materials, the bank interest, all of them are expenses. However, she has a portion of those expenses that are not yet paid, so she's owing on them. Office rent is one of them, and she's also owing part of the raw materials of 2 million, okay? So those are her liabilities. I hope this is clear. If it's not clear, we'll go back to it again in the what's it called, when it's time for Q&A, okay? So how does she now know if she's made a profit or a loss? And that's where we come to the meaning of income statement. I've told you before, your profits increases your owner's equity while your loss reduces it. Recall, assets is equal to equity plus liabilities, okay? We've talked about this. Profit increases your equity, right? So that figure you get, you just add it to your equity, increases your equity while a loss reduces your equity. Now, in order to know whether you have made a profit or a loss, you need to prepare an income statement, right? And what is an income statement? It just shows you the summary of how a business gets its income, which is revenue, and how it incurs its expenses. That is the simple definition of an income statement. So let's see what an income statement looks like. And this is Mayowa's income statement, okay? So immediately, if you're able to separate your 4 pillars of accounting, you can easily just draw up your income statement, okay? So now, don't forget, we had itemized the income under the 4 pillars of accounting, and we just brought in those figures here. I think somebody even mentioned this figure when I asked the question. The person said total income is 17.5 million, and that's it there. So the contract she got from the telco company, the school uniform contract, and then the other ones. So irrespective, in your income statements, irrespective of whether you sold it as cash or you sold it on credit, you're going to bring it in here, okay? And the expenses are as well, irrespective of whether you've paid or not, as long as it is an expense that you've incurred, you bring it into your income statement. So that was what we just did here. So we summarized all the income in here and all the expenses. And the profits, luckily for Mayowa, she made a profit of 5.8 million naira. So this 5.8 million naira, you are going to find it in the balance sheet as well, okay? Now let's move on. Now let's look at what her balance sheet looks like. If you recall the first balance, so I don't know if you're taking a snapshot of the screen, but if you can remember the first balance sheet when she started out, she had a balance sheet as at that time. Okay, this is a new balance sheet because a lot has happened in the business from when she started to the year. Okay, now what is in the balance sheet? The building she bought of 20 million naira is still in the balance sheet, right? The car she bought for 4 million naira, we still have it in the balance sheet. Okay, now her cash, I put a question mark there. Where did we get this figure from? Why is her cash? Recall that at the beginning, her cash was like 6 million naira. Now it's 684,000. So where did all the money go to? So just hold that question mark. We're going to show you, okay? Now, look at the assets column again. Debt, the money the telecom company is owing her, the 11 million, can you see there? Recall our definition of balance sheet, saying that monies owed to you for services rendered, they are an asset. So the telecoms company is owing her, that is there in her asset column, in her balance sheet. Again, the school as well, they are owing her, right? That's in a balance sheet, 450,000. That's right there in a balance sheet. Now, recall that in the first balance sheet, she brought in money. How much did she bring in? She brought in 24.5 million naira. Okay, so that's that figure there. That's owner's equity. So the savings she brought in, 24.5 million is there. Now, the 5.8 million profit she made, the one we saw in the income statement here. Remember, I told you that this increases equity. So it goes into her balance sheet as well. And that's what you can see as one of the items under equity, the 5.8 million. You can see it there, right? Now, if you go back to the assets, if you look at cash, cash is 685. Can you see that it's different from her profit here of 5.8 million naira? So this will clearly show you that your cash and profits, they are two different things entirely, okay? Now, I put drawings here of 2.5 million naira. And why did I put it there? Now, the reason why I put it there was because she took the money. She didn't pay herself salary. She didn't decide. She just took the money and decided to use it personally. And I said drawings occurs when the owner of the business withdraws the company's money for personal use. That was what she did. What she should have done differently was to put herself also on a payroll so that she separates her business money from her own personal money. She could have easily gone on a vacation using her own money, you know, after paying herself. But then she's going to draw from the business, right? So her vacation is such an example where she just withdrew from the business without considering any other thing, and she went on vacation. So that has an impact on her business, right? And if you look at, and these drawings here, is a negative figure because she took it out of the business, okay? So if you look at the impact on her total equity right now, ordinarily, if she didn't take this money, excuse me, what's going on? Please just give me a moment. Okay, so if she didn't take this 2.5 million out of her business, the figure there would have been 0, and this 2.5 million would have been part of her cash, okay? And her equity would have been about almost 30 million at this time. That would have been adding savings to, that's her equity, the money she brought into the business, to her profit, okay? So these are the ways, you know, touching funds, your business funds impact you if you don't proper monitor them. You find out that your business is not growing. Sometimes you might even be, you know, your equity will reduce further, because imagine if she had done a drawings of up to maybe 15 million. It would have dropped this to less than even the amount she brought in. So you need to monitor. Don't put your money, don't put your hands in your business account. Pay yourself some sort of salaries. Delayed gratification is really very valuable, okay? She could have waited. If she had done the proper thing, I'm sure she probably would not have taken the vacation as of when she took it. I'm not saying when you work hard, don't enjoy yourself, but can you please not enjoy yourself at the detriment of your business, okay? Now let's go to the liabilities aspect. So she has, under the liabilities, we have raw materials. Recall that she's owing 2 million. The total cost of the total expense on the raw material value for the raw material expense was 5 million. Okay, but she was still owing 2 million. So we bring the value she is owing here, right here. Rent as well is an expense that she had incurred in the year, but she hadn't paid. She was owing 800,000. So we bring it here as well. Okay. Now the bank loan from our first balance sheet, recall that we had that. Okay. So the 5.5 million is still here. And this is what her balance sheet looks like. This is a very simple model of a balance sheet. It's not, I'm not here to make you a CFO, like I said, not an accountant. I'm not using, I mean, if you read the newspapers and you look at or you read financial statements of big companies, they are more complex than what I just put here. This is just something really simple to make you understand, your finances at the level where you are, okay? So now, we have a question mark there. How is cash 685,000? And that is the third financial document you want to keep as a business owner. And it's called cash flow statement. So all the names I've put in parentheses are other names for some of these records, okay? So cash flow statement or statement of cash flow. And what is a cash flow statement? It just shows movement of cash in your business. Simple, straightforward, nothing else. Not as complicated as the other two I've told you. This one just shows how money comes in and how money goes out. Okay, so this is her cash flow statement. At the beginning, she had 6 million in her bank. Okay, she got cash. This is simply cash. It has no business with credit. Okay, it has no business with whoever is owing her. No, this is simply monies I have received and have taken out of the business. So she got cash, 4 million from the telecoms company. She got 1 million from the contract from the school uniform she produced. She got also 1 million. She also got 1 million from individuals, right? So this is the total cash she got during the year. The total cash she got during the year totals 6,050,000. Okay, and that's the value you see as total cash inflow. Now, plus that initial 6 million she had at the beginning of the year, that gives us a total cash balance somehow of 12 million, okay? But during the year, these were the things she spent money on. So again, don't forget, this is the movement of cash. It has no business whether you are owing someone or someone is owing you, right? So in the year, she paid total salaries of 1.44 million. She paid for raw materials, 3 million. Recall that the amount she bought the raw material is 5 million, but she only paid 3 million in cash. So that's why we have 3 million naira here. Okay, a bank interest, of course, if money is in her account, the bank will debit you, irrespective of whether you want to pay or not. So she paid her bank interest, and then other expenses, she paid 3.6 million in cash. And don't forget, she also took that 2.5 million. And this was what I was explaining on the previous slide, that if she did not take that 2.5 million, it would have still been in cash. The cash would be higher than 685,000 by 2.5 million. Okay, so this one just shows the movement of how you spent your money, irrespective of who you owe or who owes you. Okay, and the balance you get at the end of the day must be what you have in your account, plus also, so some of you have petty cash, you keep cash in the office and all of that. If you do that, you must get, she doesn't do that. She doesn't hold cash. Okay, she ensures that people do transfers to her. But if you hold cash, that cash in hand must also be stated here. Okay, so all of that, the balance you get must be, the balance you get from creating this statement of cash flow must be what you have in your bank and also what you have in your bag, right? Now, this figure, so this 685 is what we have there. So that was how we came about the cash balance of 685. So I hope you're beginning to get the way all of this tied together. And it's important that you understand, okay? So why do you then need your financial statements. And before I go to the reason why you need your financial statements, recall that cash is king, okay? Cash is always king. You can't run your day-to-day operations without having cash. So you always need to monitor the cash in your business, right? If you don't monitor your cash flow, you're going to run into problems. What happens when your landlord comes knocking on your door and you can't pay your rent, right? What would happen? They'll push you out, or you begin to have issues. You can negotiate, but then there will come a time that you need to pay your rent. There are some things you don't want to owe. You don't want to owe staff salaries. If you owe staff salaries, what is the implication of that? Your staff begin to leave your business. How do you begin to manage? So you need to monitor your cash flow statement. Is as important. It's not just monitoring the income and expenses that come in. Oh, let me see if I made a profit. You've seen from the example of Mayowa that even if you make a profit, it doesn't mean you have cash. You'll be looking for cash and you're like, where did all this money go to? So it's important you also have that cash flow, the cash flow, and monitor it properly, because even with huge profits and no cash, a business would not survive. Cash is the lifeblood of every business. You can always swing back into profit if you're making a loss, but without cash is really, 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 really difficult. And how can you manage your cash flow? Draw up a plan, draw up a budget, monitor it properly, okay? I mean, if you think you would need cash, I mean, you've done all of this and you still think you need cash, begin to talk to your bankers, right? And that's why it's important that you separate your personal account from your business account. These are things investors are going to look out for. I'm going to touch on that a bit during funding for your business. So why do you need financial statements? I mean, the first thing, you need to know the financial health of your company. How is my company doing on profit-wise, cash-wise? How is the company doing? It helps you with financial planning and budgeting. And how do you know the tax to pay if you don't know if you generated a profit or a loss? Would you just go and just pay any amount, right, to the government simply because you're not keeping your record? So it helps you with that. I understand there's someone coming in to take you guys on taxation soon. So the person will deal more with this. And then the last two, investors. So potential investors will take you more seriously. I run a LendTech company. If you come to me and I see that you're modeling up your business and your personal account, I'm not going to take you seriously, okay? So investors will take me more seriously once you have a clear plan, once you have, once they see your figures, once you are tidy, once you're organized, they will take you more seriously. And in obtaining a loan as well, that would help you if you're able to keep your financial statements and you know your financial numbers and what is happening in your business. Now, let's quickly go to funding your business. That links us to funding your business, okay? What are the key terms here? We talk about money, debt capital, equity capital. What is money? You know what money is. Everybody knows, even my kids know what money is. It is just known as, I mean, you need money to start up your business. You need money to buy things for yourself, even personally, not just your business, right? And it's known as capital. In business, it's known as capital, right? And there are two types of capital. There's the debt capital and the equity capital. We dealt about this in Mayowa's context, right? We talked about the equity she brought in of 24.5 million. That's equity capital. We also talked about the fact that she had to go to the bank to borrow from the bank, and that is debt capital, okay? So these are the two ways by which you can finance your business. Now, for equity capital, I mean, if you have equity capital and you think you need more money in your business and you don't want to go the debt route, right? One of the ways to do is to get a partner on board, right? In exchange for part of your business, okay? The debt capital is you still want to have 100% ownership of your business and you want to have control of it and you want to keep your shares. So you're like, no, I don't want anybody coming with me into this business. I'm okay to be on my own. However, I need funding. Then you might want to go to debt capital, okay? So, I mean, they have different characteristics. For equity capital, I mean, you have to give up part of your company in exchange for the value they're bringing in, which is money. sometimes money, sometimes it can be knowledge, okay? Then if you are giving up part of your business, just know that the profits coming into the business is going to be shared by you and the person you're bringing in. Also, if the company makes a loss, you and the person coming in also bear that loss, okay? For debt capital, I mean, the person is not sharing part of your profits, you pay them interest. And for debt capital, they don't care whether you make a profit or a loss, you pay your interest. So there are a lot of things to consider when funding your business. So what I've put here are just the definition of equity and debt funding. I'm not going to dwell on that because of time, okay? So if you see me looking down, that's because I'm also looking at the notes I put down here. So the question now is equity or debt, which is better? And the response I normally give is it depends, okay? It depends. There's no better. You need to look at yourself, even as an entrepreneur. You need to look at your personality. You need to know what you want. There are so many factors to consider. So it depends, okay? If so these are some of the factors I've put down here. So if you're saying, I still want to own 100% of my business. Okay, I'm going into debt investment. The question is, at what rate? If you take on a debt investment, would it kill your business? Would you be able to thrive? If the answer is no, then maybe you might want to consider equity if you're not able to get low interest, okay? Then another thing is if you decide to go debt and you're unable to access it, would you now stick to, oh, no, I want 100%, I want to be in control 100%, but nobody is giving you a loan. What would you do? And then you have people who are willing to invest equity. Then you might want to consider that, okay? So accessibility to debt too is also one of the considerations. Also accessibility to equity. If you want, I mean, you need to think about it. I need funding, and then I'm asking people to part own my business, but you're not able to get those people, but you have debt available to you. So accessibility to equity is also a factor to consider. Then what stage is your business right now? I usually tell people and it really depends, the stage of your business and the industry you're in, okay? So what stage of your business are you right now? I usually advise people that, when you start out, can you just start with your own fund, test it, show some sort of track record? Do it for like a year, do it for 2 years, and then, you can now talk to people. But if you look at the kind of business I run, right from day one, I needed debt investment because I'm in the lending business, okay? So right from day one, because there's always the demand for money, I needed debt. That's why I said it depends on the industry you're in, okay? And again, the stage of your business, like I said, if you're a startup, do you really want to go and take debt? You've not started generating revenue and you're already incurring interest expense. You need to consider that as well. We talked about willingness to give up ownership. If you are the type of person that is not ready to give up your business, then you have no business looking for equity. If you're the kind of person that likes control, you probably would not want to look at equity, right? Or even if you look at it, you might say, okay, just take 10%. But the question is the person ready to take 10% for the kind of work or the money they're bringing in? Okay, so if your willingness to give up equity is low, you might consider debt investment. But if your willingness to give up equity is there, then you can consider equity investment. Your environment as well. I mean, look at Nigeria. This is our environment. This is where we operate in, okay? What is obtainable in that environment? What do people do? And it ties back to accessibility to debt and investment, okay? So how easily can you access them? What's happening in your environment? Are they startup friendly? Are they not startup friendly? If all of those things are there, right? In Nigeria, they're not startup friendly. Okay, so you need to put in all of those considerations, and the few people that are startup friendly, what type of of funding would they want to give you? Then the other thing is your funding need. So what is the funding need? It's either your funding is long-term or is short-term. Okay, so if it's a long-term need, what type of investment suits a long-term need? And when I say long-term, I mean over a year. If it's a short-term need, what type of funding suits that? So for example, if someone owns a bakery, right? And he has an oven, and demand is going up, and now wants to buy an additional oven. That's the fund. He needs funding to buy the additional oven. And luckily, there's a sale. There's an oven on sale somewhere, and he can easily, take advantage of that sale. That person will probably go for a debt investment, okay, to just quickly take advantage, a short-term investment, because the kind of turnover, people buy from them regularly, they bake bread, they bake bread, and they have that high turnover. That kind of person might decide to go for a short-term loan because he can easily pay back that loan from its day-to-day generation of revenue. But then if, let's say, the expansion is beyond just buying an oven, if the person wants to open a new facility, a bigger facility, and there's a huge expansion, the person might not want to take on debt because the burden of the interest might be much, and the person might even need more than funding, might need partners that would help the person scale the business to the next level. So again, let me use myself as an example. When I started the business, I was alone. I was taking a lot of debt funding, and I was just doing my business alone. It worked for me, but by the time I wanted to expand from Port Harcourt to Lagos, and I wanted to build a platform where people can apply for loans, what happened? I got in partners that brought money into the business. So I had to go the equity route. I couldn't do debt because the kind of expenses that we had that we had was just too huge, and I couldn't add on debt for that type of expense because it was an expansion project, and the kind of debt I was getting, the interest was too high. I couldn't go that route. Okay, so depending on your funding need, that would determine whether you need an equity or an equity finance or a debt finance. So I've talked about this a bit. So the idea stage, the stage of your business and the funding type. Again, like I said, usually at the idea stage, it's good for you to just start out with some sort of funds you have. Then co-founder stage is, I gave you an example of myself. I had to bring in co-founders when I wanted to expand, right? So these people, they share in our vision. Sometimes most people do a 50-50 split. In my own case, we didn't do a 50-50 split. It was different. There are three of us. It was different. But I'm just saying likely because most times you just see people come together and they're like, oh, let's do this thing together. And then you do a 50-50 split, 50-50 split. You do half of the job, the other person does half of the job, and you guys bring in funds together, and that's more fun to grow the business. Then there's also the growth stage. So when you begin to grow, so you've gone beyond the idea stage, it's not like you've already scaled largely, but you're already beginning to get to the beginning part of the growth stage. So the money that you and your founder brought is not yet enough, right? Is no longer enough, and you need more funds. So most times, what do? We turn to family and friends. And this is our startups, okay? We turn to family and friends. And usually when you go to them, they don't usually have money. They don't usually have much, but they're always willing to support your dreams. Do you understand? And some of them give you debt. Some of them give you equity. In fact, some of them don't even ask you for interest, okay? They don't ask you for interest. They're like, okay, do what you have to do. Pay me back later. And some of them are like, okay, no problem. Let me just put my money in your business. They won't do any other thing. They'll just give you money as part of the owner of your business. I've tried to emphasize that at the beginning, depending on the nature of the type of business you have, debt may be a burden to the company. Then there are also people we call angel investors for startups, okay? Angel investor, so you've had the idea, you've started with your own money, you've gained a little bit of traction, you're growing. So these angel investors are just what they are, angels, like sent from heaven. They're like informal investors, and then they come to you and, they like your idea and they're like, okay, no problem, take this money and in exchange for equity. And usually they provide beyond money. They provide some sort of guidance, coaching. They're people you can always run to, and you always have to give them feedback on your business because they become part owners of your business. So given what I said there, where does debt now come in? Okay, so there are different types of debt for different stages of your business. So there are lending boutiques out there. Business Nurture is a lending boutique as well. And it can come in at any point in your business. I keep hammering on the fact that you should be careful, at the beginning, because you don't want to start a business, you're still trying it out, and then you lose people's money and people are on your head and the pressure is much to pay back. And also the cost of the debt is usually expensive. So where can you get debt? Lending companies, lendtech companies, fintech companies, there are a lot out there. BizNurture is one of them, right? But the interest rates from these companies are quite high for startups. BizNurture, for example, would not even finance a startup business because our rates are high. Our type of funding is for business that have already been in existence for at least 2 years, and we've seen that, okay, these people can generate revenue. Okay, so interest rates from lending boutiques or fintech companies are usually high, and it's best for you to use it short term. So you have something that you need to quickly take advantage of. I talked about the baker that needs to buy an oven immediately. You have that, you take that advantage and you're able to pay back immediately, right? You have an LPO to supply maybe, okay, one of those I coach as Chioma, she was talking about, having to supply maybe the ministry with some health products. So they give you an LPO, supply us with 200 face masks or something, right? You can use this kind of finance for that because, once you get it, you buy and then they pay you. And from there, you pay up the interest and the loan immediately. Short term, quick. Something you need funding quickly, do the job quickly, and then pay back quickly, okay? Then you also have microfinance banks. Microfinance banks do short to medium term financing, and interest rate is between, they're better than lendtech companies or fintech companies. Their interest rates are between 2.5 and 4% per month. And you find out that microfinance banks, they are more open to finance startups, new businesses, than a commercial bank will. And that's the next one I'm going to. So they finance short to long term, but commercial banks are like VCs. What are VCs? Venture capitalists. Those ones, they want to see that you are scalable, you've really grown, so you might not, you most likely, in fact, in Nigeria, you would not get a startup funding from a commercial bank. But if they see that you've scaled, you have track record, they have some small loans for small businesses now. And again, it's still based on track record. You must have had accounts with them and have been operating it for a while. They look at your turnover. So usually they don't give startup loans, okay? But they need to see that you've gotten to a certain level and your business is really scalable, right? Then they usually also don't give unsecured loans. So you need to have some form of security with them before they give you loans. And most times, as small business owners, we don't have those huge securities that they demand for, right? Their rate is between 23% and 30% cheaper, again, than lending boutiques and microfinance banks, okay? Then we have government agencies. You can get, you have the Bank of Industries, you have SMED, and I'm going to show you some examples in the next slide. So their interest rates are really very startup friendly, single digits per annum, and you can get medium-term to long-term loans from them. Now, I talked about family and friends in the previous slide. Usually they will give you what you want. They will even ask you for any rates. They are okay. Supporters, right? So they are okay and they would support you. So now let's consider this. This is like another mini case study. This is Blessing, right? This is no longer my one. So Blessing owns a business. She owns a poultry business. And what did Blessing do? She took money from a friend, which was a loan. But the loan she took, and that's the interesting thing about funding, you can get creative with it. So at one end is equity, at the other end is debt. But in between, you can mix it. You can get very creative with it. What did Blessing do? Blessing took a loan from her friend, a 2 million naira from her friend to run her poultry. But what she agreed with the friend is that the interest rate I'm going to be paying you is going to be based on the activity of the poultry. So in a month where I make a loss, you are not getting paid any interest. In the month where I make a profit, you get 10%. So if this month I make 500K in profit, you get 10% of that, which is 50K. If next month I make 300K in profit, you get 10% of that, which is 30K. In the following month, if I make 1 million, you get 10% of that. So notice that the amount this person gets, the interest this person gets, is very flexible. It's behaving like equity, because don't forget that equity capital, they share in the loss and the profit of the company. While for debt, it's usually a fixed rate, irrespective of whether you are making a profit or a loss. But this form of finance allows some sort of flexibility, so that if the month in which the poultry makes profit, the person gets money. If they make a loss, the person doesn't get money. So Blessing was able to be creative, but guess what? It's still a loan, because at the end of, say, 1 year, Blessing needs to pay back that 2 million. So it is still a loan. It's just that, you know, she's been able to design the interest payments to be flexible, to have an element of equity, where interest is determined by the level of profitability of the business. Okay, so just consider that, think about it. Now, what do funds providers look for in your business? So these are some of the things the fund providers would look out for. Most debt investors, they want some sort of collateral apart from fintech companies, and that's the reason why their rates are usually higher. Equity investors will want to know if you're ready to give out part of your business, okay? You must have your financial plans and your projections. You guys have been talking about business plan, and that also is the business plan, your pitch, your proposal. They want to see how viable this is. We talked about financial statements already, so I'm not going to overemphasize that. Equity contribution prior to seeking finance. What does that mean? How much of your money have you put in this business? Do you just have an idea and then you're bringing it to Ife and saying, give me money? There is no such thing as 100% funding. There's nothing like that. You need to have put, no matter how little, you need to have put something in your own business. So they want to see, okay, what is your own stake in this business? If you have no stake, nobody would want to put their own money. When you're not putting your own money, you're not putting your own money in the business. Okay. What other thing? They would also, so for a debt investor would ask you, what do you need this money for? Even an equity investor, in your business plan, you're already stating what you need the funds for. So you've come up with a startup cost or what the needs you need funding for. It has to be clear. You need to articulate it clearly. So what do you need the loan for? What do you need money for? How much do you need? Right? And how much do you need is not how much you can borrow. There are people that have come to me to say, how much do you guys give in Biz Nurture? And if I tell them, oh, a maximum of 5 million, oh, that's fine. Can you give me 5 million? No, it ain't gonna work that way. What do you need the 5 million for? You must be able to tell me what you need it for. You're not just going to come and take 5 million just simply because Biz Nurture gives out 5 million. If you don't need 5 million, I'm not giving you 5 million. So if you come in and you tell me, oh, this is what I need it for, and I look at it and I see that it's only 2 million you need, that's the amount you're going to get. Okay, so it's not just for the sake of they're giving money here, let me go and take my own share, in quotes. Okay, then how much do you have at hand? I talked about this previously as well. How much have you already invested in? How much do you have? Okay, how long do you need this money for? This is speaking to debt investment. Is it short term? Is it medium term? Is it long term? So we are going to articulate that. Then repayment, cash flow is important. You know, I talked about cash a lot. So is your business even generating enough to pay back this amount you're looking for? If that is not there, then a debt investor will not give you a loan. An equity investor can still give you money if the business looks viable and can generate future cash flow. But what a debt investor wants is immediate cash flow, okay? Then what form of collateral do you have if it's a debt investment, okay? Do you have, I talked about banks needing collateral. Some people don't. Some people ask for guarantees, personal guarantors. So you need to provide some of those things. So these are some of what fund provider look out for. I'm looking at the time. I mean, I'm almost done with my presentation. So where exactly can you get funds? And I've put a lot of things here. I've put some names here. Google is your friend. Please use it, okay? Google is your friend. Check and use them. These are some of the places I know you can get funds from. Biz Nurture, which is my own company, you can get funds from us. Smeadan takes care of entrepreneurs, manufacturing, those in fashion industry, food, and all of that. Similarly, Bank of Industries, you can get funds from them. I talked about microfinance banks and commercial banks already. There's a company called Growfin that back up startups in Nigeria. Please go and check them out. They also give funds and they also give grants. So not just equity or debt, they give grants to business owners. That's Growfin. I talked about business grants. That's a way of funding your business as well, depending on where you are in your business. And there are several organizations seeking entrepreneurs in certain industries, right, that give out business grants. There's also the Tony Elumelu Foundation. They also do business grants. You can check them out as well. There's Afari Funds. Please check them out online. There's also VC for Africa. If you're looking for angel investors, equity investors, go and check them out. There are lots of people signed up on this platform looking for businesses to invest in. And a lot of businesses have raised fundings from them. And of course, you can get funds from yourself and friends and family. So my parting advice to you guys in conclusion is when it comes to funding your business, play around with it. That was why I gave that example of the lady of the blessing that has a poultry, and the way she funds her business. Play around with it, discuss with people, network with other people. Okay, find out what people are doing. And you're on an entrepreneurial journey with Powen, so that's good. Where you can meet other people, attend conferences, what is happening in your industry. Okay, listen for entrepreneurial programs, competitions, for startups and all of that. Keep your records, keep your accounting records, separate your business finance from your personal finance. I cannot overemphasize that. And even for your own sanity, you need it, okay? And then it is important that your financial goals fit with your overall business strategy. So, and once that happens, this is what you call the financial strategy. You can't have a goal going A or going north, and then your financial strategy is going south, okay? So these are my parting words to you guys. Network, attend programs, keep records, work on your strategy, and play around with what can work for your business. Thank you very much. I've come to the end of my presentation. So we would go to questions and answers now, I believe, Shay.
Before we go on to question and answer, ladies, I've never said this, but when I decided that I wanted to run a program like this, one of the things I did was to attend accelerator programs myself, and I've attended, the best of them. I was part of AWEC, I was a part of the Cherry Blair Foundation, and I was also a part of ITC SheTrades. And I must say, the sessions on finance is usually a very tricky one. And I'm not saying this because Ife is here. This is the best finance session I've ever attended. You guys don't know what Ife has just done. Thank you so much, Ife. That was really, really, really awesome. Ladies, I advise you to please ensure that you watch the replay. Yeah. This session has really been, I think it's the most comprehensive session on financing, on business financing that I've ever attended. Thank you so much, Ife. That was really good.
Thank you.
So we'll go on to the question and answer. So the first question came in from Oluwakemi Ayorinde from Nigeria. Yeah, she says, should the income not be okay? I think she referred to the case study on Mayowa.
Mayowa, okay.
Yes, and she says, should the income not be the current money that has been paid, not the future balance?
No. So your income is the money you've earned, whether you have been paid or you have not been paid, okay? That is your income. It's when you now go to cash that you recognize only the cash portion up there, and then the other part is your debtor. That's under your assets, okay? So you have to recognize it, because if you don't do that, you know what is going to happen? You would likely lose track of those owing you. So if you're saying, you look at your business, okay, and then you're looking at your records and you're like, and you recorded only the cash portion and you're like, I'm not even making money. How come? Meanwhile, the problem is not with the fact that you're not making money. You're making money. The problem is the fact that you're not collecting your money from your clients. So if you see the real picture, it helps you deal with the real problem. Okay? So no, it's not, you would recognize everything, irrespective of whether you've been paid or not. So I hope that answers your question, Kemi.
Thank you, Ife. And you know, that was always an issue for me in accounting class. I didn't understand why why income that you there's a term for it, I can't remember.
Accrual.
Accruals, yeah. I really never understood that part, but thank you for that. So Nena is also asking, she says this is really interesting. So how do we run our homes without touching money from the business? Like your family assumes your business has small money, so there should be food on the table. How do we achieve this?
Okay, this is an interesting question because even one of the people I coach, one of the ladies I coach actually asked this question. Let me tell you guys one thing first, okay? Because we all come out, we teach and we say, do this, do that, and all of that. You need to consider where you are at also in your life, okay? And this is just outside, not necessarily outside what I've taught, but just understand, because sometimes it can be frustrating. Somebody has said, do this, do that, and then this is where you are, you're the breadwinner of your family, how do I do it, and everything. What I would say is, if you need to run your home expenses from your business, that portion of money that you still use for your home expense, can you pay it out? Do you get paid? I just don't want the fact that you go into your stuff, we see school fee transfer from your business account. We see payments for maybe diapers from your business account? No, take that portion you need to run your home and call it your salary. Or if you're even taking loan, you can even say, okay, you're giving yourself a loan from your business that you pay it back later, if that would work for you. Again, consider where you are, okay? Some people, what they do is they take a loan from their business and they state it there. You will see it, liability. You see that drawings, and that's why I put that drawings there. I separated it from cash. Like you are owing the company money, okay? And you intend to pay it back later. So you can do that as well, or pay yourself. So if your business, if the money you need for your home, say, is 200,000 on a monthly basis, your salary, who asked the question, Nena? So Nena, your salary, Nena's monthly salary is called 200,000. Pay it to your personal account and go and run your home from there. Don't do it from your business account. So I hope that's fine.
Fantastic. And that is so key, ladies. I think that's the number one reason why a lot of ladies do not get funding from financial institutions. Your inability to separate your business account from your personal account. It is fundamental. You know, a lot of ladies have lost funding because of that. So please take note of that. Lara Manuel says, is a car really an asset, considering that you need to fuel and maintain it regularly?
This is an interesting question. You know, in personal finance, we tell people that car is not really an asset, it's a liability. But in business, I would say yes, especially if, and I believe that this question is related to your business, not personal finance, okay? So if you're using that car to probably make deliveries and you do anything, it is an asset, because you're not going to use the car for 1 year and dump it. You will likely use it, apart from, I don't know, somebody said there are some cars that you just use and dump, okay? But you're not going to use that car for 1 year. You're going to use it over a period of time. So it is an asset. The fact that you need to fuel it and maintain it regularly, yes, is an expense. But the question is, when you fuel, how is that expense? And before you even buy the car, you need to figure out, okay, how much will I be fueling the car? How much will I spend on maintaining it? Is it better I use a logistic company to handle my delivery? Those are some critical business questions you need to ask. But if you find out that owning a car serves you well rather than, you know, outsourcing it, then it becomes an asset to the company because you're using it over a period of time. And then with assets, you expense them over, you know, because, so for example, let's use a car, right? You expense an asset over, say, 4 years. If you're going to use the car for 4 years, you begin to deduct it from your expense column on a yearly basis for the 4 years. So you just don't take, if you bought the car for 2 million naira, you just don't pick it and put it as an expense, 2 million naira car. No, because your income statement is for 1 year. So you divide that 2 million by 4 years, and you take the first year you use it, which is 500,000, and take it, and that is what you call your depreciation in your income and expense account. So if you see a profit and loss account and you see depreciation, that is what depreciation simply means. So you eventually still expense the car out. Do you get it? It's just that you don't expense it out at once, given that you use it for more than a year. I hope that's clear enough.
Yeah, that's very clear. Thank you. A second question from her: if you have more than one business, do you need to open separate accounts for all, considering the running cost of having multiple accounts?
If you have more than, and those businesses registered in different names? Do you get? So if they're registered in business names, then yes, I mean, you need to open separate accounts for them.
I totally agree with that. We have another question from Bethel Amarachi. Talking about equity, is there a provision for terminating the partnership in future?
So again, it depends. Guys, there's no one size fits all. It depends on what you have agreed in your, because when you're going into equity, you're going to sign an agreement. Don't just give up your equity without documenting what you people have discussed and what you've agreed to. So if you have, if you give out an equity in your business and you say that you want to have the option to buy back your shares, that's what you call buying back. You're collecting your shares back, ownership back in the future. If that is what you want, be open to the person you've gone to meet for investment, okay? In your pitch deck, whatever it is, let them know what you're offering them. I'm offering you 30% ownership in my business in exchange for this amount of money with a buyback option after 5 years. Okay, that's like an exit strategy, right? You're telling them that you can leave the company, or even if you want, if that is what you want to happen, by all means, state it there. So it's possible. It's possible to have that if you find people willing to agree to that terms. So yes.
Okay, so we have a question from Nena. At what point would you advise a startup to open a business account, considering taxes, etc., and that the business may not be financially stable?
So open your business account immediately. If you're not financially, you don't pay taxes on losses, irrespective. So when you say financially stable, I want to assume that maybe at the beginning, you are probably incurring a loss. You don't pay tax on losses rather. So I would advise you to do that immediately for your sanity. Trust me, it's really very good to do that immediately once you start. And I'm sure the tax person will the person coming to take taxation too will deal with this a lot.
Yeah, I also wanted to add to that there's a moratorium for, I think, about a year for startups that you don't have to pay taxes. And even that after that's 1 year, if your turnover is not up to a certain amount, I think 20 million annually, I'm not sure.
Yeah, I think, 20 to 25. Yeah, I'm sure they will give you, the experts will give you the details.
Yeah, the experts will deal with it. So it's in your own interest to, right now, the laws favor SMEs. So there's really little or no tax that you have to pay as a startup. Okay, so Damilola asks, what's the difference between grants and loans?
Okay, so for grants, you don't pay back. For loans, you pay back. That's the difference.
All right then. Kemi also asks, how do we factor in bad debts?
Okay, so factoring in bad debt, so that would now depend on the policy of your company. Okay, so some people so let me use me as an example since I do that, right? So in my company, our policy is to always expense 10% in bad debts, okay? And your bad debts, once you expense that, it goes into your expense. So you're reducing your profit by that figure. So that's simply, so you need to decide on what percentage of debts you want to make provisions for, right? If it's 5%, you put it in there. If it's 10%, but make sure it's consistent. So don't do 5% today, 10% tomorrow. I mean, you won't, it will be so confusing, right? Just take a percentage. If it's 10% you want to make provisions for, you will take that in and then you make provision for that. However, there are times that you even make provision for bad debt and what you have to write off at the end of the period is more than that 10%, right? So, you have your debtors, say your debtors is 10 million and you have to write off 1 million because it's not coming. right? You reduce your debtor's value by that 1 million, and that 1 million, you reduce your profit as well by that. So it goes to your expense, okay? So yeah, that's how you factor in bad debt.
Okay, so Damilola is asking a second question. Would you have advised Mayowa to pay off her debt from her profits?
Not necessarily. So it depends. You see, guys, debt is not bad, okay? Because we all have that notion that debt, if you take a loan, oh my God, it's going to, the world will end. So debt is not bad, okay? I would not have advised her to pay up. She had 685,000. Where does she even want to pay it from? Right? So she had more profit, except she didn't have the need. And that's why you need your cash flow. You need to know the needs of your business at a particular point in time. If she had a lot of money just sitting down, why should she be incurring interest expense? But it's not like she had a lot of money. So she had to still have that bad debt. So for me, I would say, if you look at your cash flow and you don't need funds immediately and you have some form of money, please by all means reduce your debt if you have debt. But if you don't, or if you need funds where you can even generate more money, right, than paying off your debts, then why would you want to pay off your debt? As long as there's good debt, as long as the debt is not ruining your company. In Mayowa's case, the debt wasn't a problem. She went on vacation when she shouldn't have gone on vacation. Yeah.
All right, thanks. Okay, so and Sandra is asking, is it wise to take up a loan to start up your business without having any sort of financial backup?
I personally, so, I explained that it depends on the type of business you're starting. I was starting a lending business and I'm not Otedola or Dangote, so I don't have any money stashed up somewhere. So this was me just, knowing people who had, taking their debt and giving it to people who needed. So that while that worked for the lending business, a typical business, I would tell you to be careful, okay? Using startup debts, particularly if you have to service the interest. If the type of debt you're taking is the type that gives you, say, a moratorium is a grace period. So you're not paying interest, say, for the first 6 months. And by the time you've drawn up your business plan, you're sure that revenues will be coming in and you can pay up your debt from after 6 months, you might consider it. So there's no one size fits all. You need to do your plan. You need to critically look at your business. I personally will not take up a loan to start up. I mean, if it wasn't a lending business, I would probably use mine because I just don't want that headache of people coming to disturb me for their money, right? I want to try it out. I want to see, would this thing work? I don't want that pressure, okay? So that's what I will do. But then people can do different. I know people who have taken loans to start up there and they are doing fantastically well. Okay, so they've drawn up their business plan. They see that it's really viable. They were able to get some sort of moratorium. No interest was charged in the first 6 months. And where do you get those kind of things? Bank of Industry, Smedan. I mean, you can't get that from most debt investors, except you have a very nice angel debt investor. Then you can get that. Yeah.
Yeah, good thing is that, and we have two people who will be talking on how to pitch your business for financing. And one person is focused on pitching your business as a startup.
Right.
That's the session we're having tomorrow. So Aisha will be talking more as a startup. Do not take debt. Everyone will tell you, if you can avoid it as a startup, don't take debt. So if you're not taking debt, how else can you source for funds? Yeah. So Aisha will be, talking a whole lot more about that later. And then we'll have Fade Ogunro talk about, financing your business as for growth. Yeah, when you have track record. So don't worry, ladies, we've got it covered. Anonymous attendee, you are not going to get any points for this. Just know that, because we need to know who is attending and who's asking this question. She says, what are the key components of a balance sheet that we should always have in mind?
Okay, so we talked about assets, we talked about liabilities. You always want to track your cash, you always want to track your debtors. Because cash is, I've emphasized this a lot, it's king, it's the lifeline of your business. You want to know that you have cash to run your business. The other part is your debtors, right? You want to know those owing you. You don't want your monies sitting somewhere while you are probably even going to get loans and you are paying more expense on those loans. So you want to also monitor your debtors and how long it takes them to pay you. Are you the type of person that people will owe you for, say, 60, 90 days? And you're not doing anything about it. Meanwhile, in your typical business, people are getting paid within 30 days. Then there's a problem, okay? So you want to know your cash, you want to know your debtors, okay? Also, you want to know your creditors because you don't want things falling due and at the end of the day, you can't pay them, right? So I think I've even covered more, and those are the things you find in the balance sheet, okay? So you want to know, you don't want to be owing rent and then you have no idea of what you are owing. And also, when you know that that payment is falling due, where's the money you're going to use to pay? So cash goes back to cash again. So yeah, that would be my response to that question.
Oh, okay. So the anonymous attendee, she's identified herself. She's Melvin from, I think she's from Gambia or Cameroon. I'm not sure. Yeah, she's either from. All right. So I want to ask a question. No one has asked it, but I think it's a question that quite a number of entrepreneurs often ask. So when you're looking at your balance sheet, what would you say should be a safe debt to equity ratio?
Wow. So, okay, and that's why people always ask. You know, I've said a lot of it depends on this call. Okay, it depends. So the Jerry, and it's called a Jerry ratio. So your debt to equity ratio, that's what it's called. Okay, so in a bank, for example, a financial institution or a lending company like ours, because we take debt a lot to finance people, it's going to be high. You will see as high as 80, 90% as the debt to equity ratio. Okay, but then in a typical business, people usually say don't let it be more than 50% or 51%. So let the equity be like at least 51%. Some people say that. So again, I would say it depends, but also you want to monitor it because you don't want debt in the industry where you are. What is obtainable there? If you set a figure for yourself and say my equity to debt ratio will be 80%. Meanwhile, in your industry is 30%. What now happens? How do you cope with that? You put yourself under unnecessary pressure. So it's good to compare your business to what actually happens within the industry you are in, okay, to answer that question, Sheyi. Okay. So again, it depends.
Okay, all right. So we'll just take 3 questions and that's it. So Shogo asked that, is it advisable to open a business bank account with a microfinance bank?
If it serves you, if the requirements serve you, you can go ahead. Yeah.
All right. Now, Precious is asking again, if I get a loan as an individual and borrow my business, how do I treat that?
This is a fantastic question, actually, because people do this. There was a lady that started her business in, I think that was like 2 years ago. And, you know, she had called me up and she said she wanted a loan for her business. She was just starting and all of that. And I'm like, do you really, really want to? I think it was a coffee shop. And I was like, do you really want to take a business loan for your coffee shop that you're just starting? I mean, how many cups of coffee do you serve in a day? What's your revenue like? And all of that. She now said, oh, that she'll be paying back from her salary. So it was a side hustle. Okay, so she was still working a 9 to 5 and she was going to pay back from her salary, not the business. So I was like, okay, so that is you literally taking a personal loan because repayment is actually coming from her salary, right? So it's something you can do as well. It's an option. Okay, so you can take an individual loan because you already have a source of income that you are paying back from. I would advise you to treat it as a loan to the business so that you know how exactly the business is doing. So when you take that individual loan and you're paying back, you know, from whatever source you're paying back, right? And you give it to the business, it is, if you're not giving me, so there are 2 things. The question is, is that your equity contribution to the business? You can give it as an equity contribution to the business. Like, okay, fine, I don't have money now. I've not saved enough. However, I have a 9 to 5 job that can pay up that debt for this money I need. So you can take it to the company as an equity investment. Okay, like that's your equity contribution. So you're not expecting the business to pay you back, right? The alternative is you can take it to the business as a loan. and the business will pay you back when it can. What I did was actually the latter. And again, guys, my solution is different from the solution of another entrepreneur. Okay. So what I did in my own business, given the nature of my business, was the money I first of all put in when I was alone as an individual was actually a debt to the business, and it paid me back. But by the time I had partners on board, I actually put in equity in the business, irrespective of where I sourced the equity from. So I hope that answers. So you can treat it the way you want to treat it. It depends on what business do you do. I mean, I can probably give you a direct answer if I know the kind of business you do, right? But it depends.
Okay. All right, then.
Take a loan and say that is your and don't expect the business to pay you back, or you can put it as as a debt.
Okay. This is the last question we'll take. I mean, the questions are pouring in, but I think we need to go now. Bethel is asking that, are there financial book templates that a startup can use as a guide? If yes, which would you recommend, or where can she get from?
Okay, like I always say, Google is your friend. Every resource you need in this life, most resources, they're on Google. So please go online and Google startup materials that we can use. And you would find a lot. There's so many online, Sheyi. There's so many. So just use Google and you'll find them. I don't have specifics for you today.
I totally agree. I mean, do your research. Google has, I said there's nothing you can't find on Google if you're patient and you get your keywords right.
Yeah. And then one more thing, Shay, let me just add that, however, if you want what's it called, apps that help you, you can put in your records, help you track those things, I would recommend Wave apps. There's also QuickBooks. I heard there's also Zuhu. So if it's apps to help you with your financial records, then check out Wave apps. Wave as in you're waving, then apps, then QuickBooks, then Zuhu. Yeah, there's Zuhu as well. So I know those three. So you could check those ones out. So yeah.
I know them too, and they are quite good. I mean, I like Wave. Wave even helps you to do your invoicing.
Yeah, exactly.
Yeah, that's very, very good apps. We can't thank you enough. I mean, this session has just been, it has been quite explosive. It's been quite detailed and comprehensive. Thank you so much. We really appreciate it, and we hope we'll definitely, count on your support in helping our participants become sustainable and successful businesses. Thank you so much. All right, ladies, that's it for today. Tomorrow we'll continue same time with Aisha. Let's make it a date. All right, then bye everyone.
Bye.